Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds. This is a review of markets for October 2019. As we noted in our last monthly, October presented a number of binary event risks for markets, which we would need to navigate, and they had the ability to send markets in multiple directions. Over the course of the month, there has been renewed optimism in global markets, as two of those major event risks have now passed, with probably better outcomes than some market expectation had been factored in. Firstly, the exclusion of a no-deal Brexit in the UK, the market has seen as a big positive. It was potentially a very chaotic market outcome, given that the UK sits right at the centre of the European financial system. We still have elections to face in December, and there is more to go in the Brexit saga, more than 3 years on. But for now, hopefully a hard deal Brexit is off the table, and that's good news for global markets. Secondly, there has been some improvement in the US-China trade deal, with a phase one deal agreed in principle, pending the documentation to be completed. It's a fairly light phase one deal, but nevertheless, it gives both parties a chance to go back to their respective vested interests and say that they are making progress in the US-China trade war. But the devil will really be in the detail. For now, markets are happy to run, that there is improvement, and clearly we've seen a breakout in terms of the risk space, with equities doing very well and some pullback in bond markets, holding that negative correlation which has been evident over the course of much of the recent market profile. There is also optimism around the global data, which has stabilised, albeit at very weak levels. So where we had seen the global macro data accelerating lower for much of the latter part of 2018 and through 2019 as a result of the trade war, but really as a result of the Federal Reserve rate hiking cycle from 2016, 17 and into 18, there is some stabilisation in that data, which is a good news story in and of itself. Does that mean that we're going to get a green shoots moment and that data can accelerate now? Or is this a pause before we have weaker data as we push into next year? That remains to be seen. But again, risk markets are hoping that this is a turning point, a mild inflection point. We remain somewhat cautious on that. We still think that the construct of markets is unlikely to lead to a material macro acceleration. But given that we have had rate cuts over the course of 2019, a muddle-through scenario is absolutely possible. And if that occurs with low volatility, risk markets will love it, given that policy support is very much in full train. We've had a number of interest rate cuts over the course of this year, and that's certainly helping to extend the cycle to some degree. Looking ahead for the RBA, we still expect that the RBA will be cutting interest rates early next year, and the market's expectation has moved more from November, December this year forward to February of 2020. And we think that makes sense. There will no doubt be a conversation and a discussion around quantitative easing for the RBA beyond rate cuts. Once we've had one or two more rate cuts, we are running out of ammunition on that rate lever. And I think that'll be a very interesting debate, no doubt, over the course of 2020. We also expect that the Federal Reserve will have more to do into 2020. We firmly expect President Trump to be tremendously vocal about trying to deliver more stimulus for the US economy coming into his election year in November of 2020. And other central bankers certainly look like they might have more to do. We've seen very dovish or interest rate supportive policy from the Bank of Japan and the ECB still acknowledging that their global pictures are very, very weak. So whilst we have this pause and assess over this Christmas period, we do expect the new year to open up with further accommodation, which should be very supportive of markets in general. Thank you very much.